In this video, I'm going to talk about 5 things that you must be aware of or understand before you trade futures on Bitget so you don't get liquidated or basically lose all of your money, as trading futures is really risky if you don't know what you're doing. This video is pretty much geared towards beginners who are looking to get started with trading futures. In other videos, I'll actually show how to place trades on the long and short side. Now, before I get into the 5 things, if you don't already have an account with Bitget by chance, I'll leave a sign up link in the video description where you can save 20% on your trade fees. With all that said, let's get started. So the first thing that you need to understand is that when you're trading futures, you always have to use your funds as collateral. Whenever you put on a trade, you could potentially lose everything that you have, even if the coin's price doesn't go to zero. This is completely different from the spot market, where you can only lose what you have if the coin's price goes to zero. This is because in the spot market, you're actually buying the coin, but in the futures market, you're just placing a bet on whether the price will go up or down. Now, you may be wondering how it's possible to lose all of your money even if the coin doesn't go to zero, and that brings me to my second point, which is leverage. When trading futures, you can leverage the amount of money that you're playing with. In other words, borrow money to trade with. This doesn't mean that you actually own that money. It just means that you can trade with more than what you have. So when you're on Bitget's futures trade dashboard, you'll see something that says leverage and then a number and then an X. Now, if you click on that, there will be a slider that opens up and you can basically choose the amount of leverage or the amount that you'd like to borrow on your trade. So example, in this particular case for Bitcoin, you can leverage as low as 1 or you can leverage as high as 125 times. Now remember, this is money that you are borrowing. This is not money that you actually have. So here's a simple example, but in real trading, it's a bit more complicated than this. Let's just say that you only have 100 USDT in your account. You leverage that by 10x, which means that you now have 1000 USDT to trade with, which you use to enter a trade. Of that 1000 USDT, 100 USDT belongs to you and 900 USDT belongs to Bitget. If or when the market value of your trade becomes 900 USDT, then you get liquidated, meaning that you're forced out of your position and Bitget takes your 100 USDT and the 900 USDT is returned back to Bitget. This should make sense because you only had 100 USDT to play with. Bitget just let you borrow 900 USDT, which you have to pay back plus any interest. I've made a table illustrating the percentage moves that can get you liquidated based on your leverage factor. Keep in mind, this table doesn't account for interest, which brings me to my third point, which is funding. Now, going back to the trade dashboard on Bitget, if you look over here, you can see that there's a funding rate section. There's a percentage and a countdown timer. So the way the funding rate works is every 8 hours, interest, in other words, funding, is settled. This number can be either positive or negative and can change at any time. The reason why this number changes is because it depends on market conditions. Basically, it depends on the amount of longs versus shorts. So when the number is positive, it means that longs have to pay shorts, and if it's negative, then shorts have to pay longs at the end of the countdown timer. This percentage is based on your outstanding position. So let's take a look at an example. The funding rate on this is minus 0.8214%. This means that at the end of the countdown, if you're in a short position, you would need to pay 0.8214% of your outstanding short position in interest. So let's say that you have 100 USDT and you leverage by 10x and you entered a short position. This means that you're in a 1000 USDT short position. By the end of the countdown, assuming that this number is still the same, you would have to pay 8.214 USDT, which gets automatically deducted out of your margin balance. This means that of your initial 100 USDT that you had, you lost 8.214 USDT and you now have only 91.786 USDT in your margin balance. However, if you are on the long side, you'd have 8.214 USDT added to your balance. As this affects your margin balance, it can also affect any open positions depending on how you collateralized it. This then brings me to my next point on isolated versus cross margin. Now, going back to the trade dashboard on Bitget, so over here, you'll see where it says cross. Now, if you click on it, it'll bring a pop-up menu where it says the coin's name and margin mode. You then have two options to select: isolated and cross. So basically, this here is asking you how you would like to collateralize your debt on your open positions. For isolated, only a specific portion of your funds is set aside and at risk for a particular trade or position. So if you enter a position with 100 USDT, you can only lose that 100 USDT even if your futures account has more funds than that. However, for cross, all the funds in your futures account will be used as collateral for any open position. This won't really affect you if you only have one position open at a time, but it will, however, affect you if you have multiple open positions. One bad open position can get you knocked out of all of your open positions and liquidated if you were on cross. One thing to note is that you can't change the margin mode once you've entered a position. Now, the last thing to be aware of is this calculator over here. I think that this is an underrated tool that shouldn't be looked over. So when you click on the calculator, it'll bring up a calculator where you can enter your information and it'll help you calculate different things. I would say that you'd want to focus primarily on this liquidation tab the most, as it'll help you determine what your liquidation price is. So as an example, let's just say I'm longing Bitcoin. I'm going to leave this here at cross, and let's just say I enter my position at 27,000 USDT and I'm longing 0.01 BTC, and I only really have right now 30 USDT, as you can see over here. And if I click on calculate, it'll determine my liquidation price right here, which is 24,108 USDT. Now, if I were to adjust the numbers, the liquidation price would also change. So let's just say instead of my balance being 30 USDT, I've now got 100 USDT to trade with. So if I click again on calculate, you can see that my liquidation price has gone down to 17,108. Now, this should make sense because I'm using less borrowed money to trade with, or I'm putting up more capital, so therefore my liquidation price would go down. Now, be sure to always know what your liquidation price is before you enter any trade, as you never want to trade blindly, especially with futures. Although Bitget does tell you your liquidation price before entering a trade, this calculator is useful when you want to play around with the numbers. So those are the 5 things that I think that everyone needs to be aware of or understand before you even begin to trade futures, because of how risky futures are, especially when you don't know what you're doing. Again, in the future, I'll be posting videos showing how to actually long or short on Bitget. Hope you learned something, and thanks for watching.